All right, well, thanks, Eric. All right, thanks, everyone. Thanks for joining today for Multnomah Group's 2021 Regulatory Roundtable. As many of you know, we publish an annual regulatory update, and this webinar is in conjunction with that about 15 to 20 page document that sort of covers everything over the past year and also discusses some of the upcoming things that we see in the retirement plan industry. So joining me today, well, first, my name is Greg Johnson. I am a senior consultant, and I am the director of our ERISA Technical Services Committee. Joining me today is Haley McLaughlin, who's a consultant and the director of our Vendor Services Committee, and the managing principal of Multnomah Group, Eric Daly. And today we're going to walk through a legislative update, an update on IRS and DOL activity really over the last 12 months and some forward-looking things. And then, of course, provide a judicial update on some of the retirement plan lawsuits and what we see happening there. So when we talk about the legislative update, we thought it was good to sort of start by looking back at the Secure Act again. Some of you may be saying, why are we looking at the Secure Act? That thing was passed in 2019, which is actually true. It was passed in December 2019. But the problem was about 3 months later, coronavirus came swooping in, and really the CARES Act provisions took front and center for at least much of 2020. The CARES Act provisions have largely expired, so most of those are not available. There's a few learnings that I think we took from some of the legislation there that may continue to move forward. But I think what happened was that in 2021, people refocused on the Secure Act and started thinking about what are these provisions. I think guidance on some of the provisions came out much slower than you would typically see, because Secure Act at the time was really deemed the most substantive overhaul of the retirement system in over 10 years, yet adoption of it of some of the provisions have been pretty slow. So we wanted to walk through a few of those. Maybe get some insight from Eric and Haley on sort of where those stand. So one of the first items was the expanded availability of multiple employer plans through open MEPs, actually through open PEPs, which is a new kind of plan that's called a pooled employer plan. What this did was first allowed, it used to be that to have a MEP, you had to have some common interest between the employers. And this allows just any group of employers to come together. Typically, I think what it'll be is with a third-party provider that will manage the plan for them. And then this also got rid of the one bad apple rule to make these a little more attractive. The one bad apple rule said that if you have 10 plan sponsors or 10 employers in a plan and one of them is doing bad things, the other 9 may be in trouble as well. So it removed that. But I think the first question is probably for Haley. I know that you have to register if you want to offer one of these types of plans. And as the head of our Vendor Services Committee, what are you seeing currently as it relates to these PEPs, and what do you think the future is?
Yeah, I think that these open MEPs or PEPs or group of plans, all similar things on a spectrum of integration, are really interesting. And the PEPs specifically, because you're removing that requirement for the sponsoring organizations to have some sort of related interest, you really allow these to become basically a product that can be purchased. So a pooled plan provider pulls together someone to do custody and record keeping and administration and the investments. And then, they've set up shop and really anyone can join. And you do have to register with the Department of Labor to be a pooled plan provider. And we are seeing sort of a variety of different organizations that have already filed. Very large record keepers, certainly names that I'm sure everyone on the call would know. You also see third-party administrators, which makes sense. You see consulting and advisory firms doing it. Also interesting to me is we've seen a couple of payroll companies join that fray. So really, folks are probably looking to become a one-stop shop for benefits, and that's who's setting up to do this work. And I think we'll continue to see that as a trend. I think my concern and our concern is in watching these that it will be sold as maybe an easy button that you can sort of sidestep some of your fiduciary responsibilities by just joining a PEP and calling it a day. And I don't think we're there. I don't think we'll ever get there. And in fact, having all of these sort of interrelated services may increase the potential for some conflicts of interest, especially if you're not receiving sort of any independent advice or any assistance in really monitoring these services. So I think that's my general concern.
Okay, no, that's helpful. Secure Act also had some increased tax incentives for small employers. Small employers were 100 employees or less. This was part of the Act's attempt to encourage the smaller employers who don't currently offer plans to begin offering a plan, or those who do to add an auto enroll. So there were some incentives for those. There were two lifetime income provisions. One of them related to illustrations to participants, so reporting on statements, what lifetime income might look like based on their current balance. There was actually a recent FAQ to provide some guidance to plan sponsors on this. The one question that I think is of note was that the latest that you can begin including illustrations is on the second quarter 2022 participant statements. So that would come out sometime in the third quarter. But based on when this became effective, that's when that'll be required. It also indicated that additional illustrations can be provided. Many record keepers provide their own illustrations, arguably maybe more accurate because a lot of them have some forecasts about future earnings. The way the DOL is requiring it be done, it's just based on the amount that you have in your account now, what would it be worth as a lifetime income stream in the future? It's not really clear if you have a record keeper doing their own, if that replaces the DOL requirement. So I still think we need a little more guidance on that. The other aspect related to lifetime income, though, was a safe harbor for offering an in-plan annuity option. So in other words, when someone reaches retirement, there's the ability to create a lifetime income stream within the plan rather than having to take the money out and purchase an annuity if a lifetime income stream is something that's important to you. I think a lot of you in the nonprofit world would know that lifetime annuities are very common in 403B and nonprofit plans. I think this is really something that's going to impact over time, have a bigger impact on for-profit organizations and 401k plans. And I think for that, I want to sort of turn it over to Eric and get some thoughts on, what do you think, first off, what do you think the take rate on this in 401k plans will be in the first few years? And what do you see longer term, the impact on really retirement savings in the whole country?
Yeah, I think there's a few issues at play. I think there has been at least a long-held belief that the reason more defined contribution plans didn't have lifetime income availability was the fiduciary risks associated with providing that, right? That I, as a provider, select an insurance company, the insurance company goes belly up, and now I'm liable as a fiduciary. I'm not entirely certain that that's the case. I think plan sponsors take fiduciary risk all the time, and seem to do so, when there is an adequate audience that is looking for a solution. And a case in point, which we'll talk about later, would be ESG, where if you look across the country, you see a number of employers, despite the fact that guidance is unclear on whether environmental, social, and governance products can be used, they're electing to make those available to participants because participants are requesting them. I think on the 401k side, what we have had occur is, these plans have become, especially for the middle class, wealth accumulation instruments. And I'm not sure how many of that broad swath of folks that have availability there are, at least during the accumulation phase, that interested in retirement income. There is a tremendous amount of academic research that supports unequivocally and unquestionably that retirement security for Americans would be higher if participants elected to annuitize at least a portion of their benefit. However, there's lots of things that we do that academically make sense that Americans still don't feel comfortable doing. And it does call into question complexity, right? If you go back 20 years, defined contribution plans were relatively simple. And we have begun making them more complicated, changing the tax treatment for deferrals. changing the ability to convert accumulated dollars to a different tax treatment, creating more in-service opportunities for distribution. All those things are complicated. They are made to look very simple in comparison to the complexity that goes into even the simplest type of retirement income products and plans. So I think the short-term answer is it will have very little impact. I think there is a tremendous amount of effort being exerted by the financial services marketplace to try and engineer, design products that make sense there. All of them will have complexity, and especially in an environment like the one we have now, where disclosure to participants is the order of the day. Trying to disclose those products adequately to participants so they understand what they could be electing into, I think, is difficult. There's work being done, and it's clearly being done in managed accounts and target dates, all oriented toward trying to come up with retirement income solutions. But I expect that that's going to be a really, really slow slog. And I agree, Greg, with your comment about these projections, which is, I think the projections will also lead to a great deal of uncertainty, discomfort, and misunderstanding, right? I think the Department of Labor was very, very concerned that somehow participants thought that target date funds guaranteed retirement income or guaranteed an account balance by a retirement date. The notion that there isn't a similar level of concern about these projections and how participants could misunderstand them, I think seems to miss what could be a concern going forward as those become pretty prevalent by, as you mentioned, Q2 of next year.
Yeah, we'll talk later when we talk about the Department of Labor about some of the confusion they created with their fee disclosures. So we might be heading down the same path here, but we'll have to see. Yeah, but I agree. I've said before, this is something that I anticipate being sold at first, not bought, as additional products. I do think people will come out with good quality products, though, that will meet the need maybe better than they do today. And so in the short term, it's not a high adoption, but I think, personally, I think 10 years from now, you'll see quite a few lifetime income options sitting on 401k plans that you don't see today, but time will tell.
So I get that chance to listen in on a small group session hosted by the chairman of the House Ways and Means Committee, Representative Neal from Massachusetts. And it's really clear that he's passionate about this issue. He thinks that longevity risk and retirement income is the order of the day. And as one of the primary architects of a lot of these Secure 2.0 bills, he certainly is convinced. I'm not sure that the participants are, but certainly Representative Neal seems very focused on the issue.
Yeah, that's interesting. You got to get it in the plan before you can see if people use it. So the other pretty significant item in the Secure Act was the penalty-free withdrawals for birth or adoption of a child. This allows up to $5,000. Actually, each parent would be eligible to take that if they have access to a retirement plan. Those amounts can be repaid. There was something, I think, in Secure Act 2.0 that would require it to be repaid within 3 years. Ultimately, I don't see any way that goes through because it sort of waters down the whole value of this. But this is a provision that needs to be adopted by the plan. So if this is something you want to offer to your employees, you do have to adopt it. There are also additional Secure Act enhancements that are in the longer report that are detailed in the report. A lot of them are sort of one-off items that do clean up some just sort of long-standing issues that as practitioners we've had. So next we want to talk about some of the proposed legislation that's out there. And the biggest one that's being talked about is Securing a Strong Retirement Act. This is the House bill that's Secure Act 2.0. Here's a few of the provisions that it entails. First, Secure Act extended the required beginning date for taking required minimum distributions out to 72. This would extend that further over to age 75. It also reduces the penalties for failing to take your required minimum distribution. Today, as many of you may know, it's a 50% penalty on the amount that was supposed to be withdrawn. So pretty hefty penalty there. This would reduce it to 25%. And then if it's corrected within 2 years, would reduce it even further to 10%. There's also a requirement that new plans have to adopt auto-enroll and auto-escalate provisions. So anyone starting a new plan would be required to start with auto-enroll at 3% and then that would ratchet up each year up to 10%. Eric, what are your thoughts on what are your thoughts on mandatory auto enroll? I mean, I think we're seeing quite broad adoption of it by a lot of plan sponsors, but should it be mandatory?
Yeah, the challenge with automatic enrollment, we've talked about this with clients who've elected to put it in plans frequently. It's only as good as your ability to utilize it the way intended, right? So every once in a while, we work with a committee who wanted to put automatic enrollment in a plan, but you'd have the direct benefits person or HR person essentially grab every employee and say, hey, if you don't opt out by January 2nd, we're going to take 5% of your first paycheck. So I'm somewhat question how effective it could be. It does create some air cover, because while the movement on automatic enrollment and auto escalation has been really, really heavy over the course of the last 8 to 10 years, we still do run into the periodic objection about this being too paternalistic or mandates, and in creating kind of the cultural environment that makes that difficult to do. And while I think already the trend is in this direction and that most employers are finding some air cover there, certainly making it mandatory creates mandatory air cover. But it is important to understand that the primary issue here is actually doing it effectively. Meaning allowing actually people to automatically enroll is essentially, instead of forcing them to make an election, because when you do that, you find inevitably that your enrollment rates go down to basically what they would have been if they had opted into the plan under another structure.
Yeah.
So I think that's certainly a big piece of it, but also not sure that it really solves the primary problem. And the primary problem is coverage more so than savings rates, and most progressive employers are finding ways to get the savings rates where they need to get them. The problem still continues to exist, and consistent with Haley's concerns about what happens in that small plan market, and even with the tax credits, I don't know that there's any evidence that small micro employers are electing to start their own qualified plans. I just haven't seen any academic data that supports that. The only thing that seems to have made any difference on the coverage side is the state-run plans that are becoming more and more prevalent across the country.
Well, and that's the rub, right? Is the state going to solve it, or is the federal government? And that's what we're still trying to figure out. So
yeah, and I just it's hard to imagine that these tax credits are going to be adequate to get a 3-person, 4-person business to get in the business of sponsoring a qualified retirement. And I think that's a tough ask. PEP environment, simple environment. I mean, they've tried a million things. And Greg, you said earlier the notion of these things are bought, not sold, or sold, not bought. Pardon me. And in the small plan market, let's be clear: if you're trying to get a qualified plan set up, those are almost always sold by a broker on a very expensive product set, or potentially the accountant finally comes and says, "Hey, Nancy, your business is making too much money. We need to find a way to get some of this into a qualified retirement plan. Let's figure out a way to solve the problem."
yeah, to save on taxes, right? Which takes us right to the next bullet point here, which is a pretty significant change. It has a provision that all those age 50 catch-up contributions would no longer be allowed to go in on a pre-tax basis. They would all go in as Roth contributions. And, for Haley, I think the question to you is, what impact do you think that'll have? I mean, do you think people understand Roth savings and they're still willing to do their catch-up if they have to pay taxes on it? Or are they just going to say, just give me my money?
I think it might have an impact on savings rates. We've seen Roth, take up the usage there in plans. And so I think some people are starting to understand it and are taking advantage of that. But I think it's also certainly going to irritate a lot of people who wanted to do those in a pre-tax environment. This sort of Rothification of the retirement plans has been a specter for many, many years. And there was talk of making all retirement savings Roth. This is maybe a half step towards that. The cynical side of me says that this continues to be sort of a lever for revenue, because this tax deferred is really expensive from a budgetary perspective. And so if you're pushing out RMDs and delaying that tax revenue even more, maybe this is a way to pull some of that back. So it continues to feel more like a politicking lever than really anything else to me at this point.
Well, it's there to generate revenue for sure.
Yes.
That they're otherwise missing out on. So no question there. A couple other provisions that it has are, this one's caught a lot of attention. This idea of helping employees who are, saddled with a lot of student loan debt. Those employees say, well, I'm trying to pay off my loans, so I can't participate in the retirement plan. So I'm in a bad spot. There have been, provisions to allow, well, there's a, one letter to a specific employer that allows them to go ahead and make matching contributions on payments that a student makes on, or an employee makes on their student loan. This would have legislation allowing for it. I think on this one, the devil is sort of in the details. It's typically when some of these unique provisions, record keeping provisions come up, the employer's record keeper takes care of them. This one, it's not quite as clear. How are you going to verify that the employee is making their payments that they're supposed to? So I think, conceptually, it's a great idea, right? We'll go ahead and contribute to your retirement plan as if you were making your own employee contributions. But maybe when you actually implement it, it's a little more complicated than you think. So I think there might be some further guidance that's going to be needed on what otherwise seems like a good idea. The other item is the national database to identify lost participants. I think this is growing. This is getting a lot of attention lately. I think the focus on small balances, missing participants, lost accounts continues to be addressed. And I think we're going to see a lot of activity, honestly, from probably Department of Labor and maybe even further legislation related to trying to figure out what we do with these lost accounts. There's some additional retirement proposals out there as well. The Improving Access to Retirement Savings Act, that's actually the Senate version of essentially Secure Act 2.0. If that were to pass, you're going to see the House and the Senate come together and sort of try and pick out the best of both of these and end up with a bill that ultimately will pass. The Enhancing Emergency and Retirement Savings Act, there's a lot of focus on the fact that Americans don't have any emergency savings. This act would allow an individual to take out a maximum of $1,000 per year for an emergency, and it doesn't state what that emergency is. So it is pretty open access. The check on it, though, to ensure that people don't just come here and grab $1,000 every year, is you can't take another $1,000 until you've repaid the first $1,000. Again, conceptually, I don't have any problem with this. I do have concerns about opening up the retirement system too wide so that people just use it like a piggy bank, because I think we continue to see that happen more and more. But at least this has some limits and controls around it. Next, the Keeping Your Retirement Act. This actually expands, similar to Secure 2.0, expands required beginning date to age 75. It just does it immediately. The Increasing Retirement Amount Act, this one actually focuses on IRA savings, increases the IRA limits from 6,000 to 12,000, and increases catch-ups from 1,000 to 3,000. This sort of goes back to, I think, Eric's point about it's not about getting people to save, it's about giving them access to savings vehicles. And the reason the Increasing Retirement Amount Act really was set forth was because most people whose only vehicle to save for retirement is through an IRA max out at the $6,000. So I think this is important to get this increase. I don't know if it'll pass as its own separate act or if it'll be sort of pulled into maybe some of the discussions around Secure 2.0. And then finally, the Building Back Better Act. Been hearing a lot about that, but certainly not the retirement provisions. There actually are a few retirement provisions in that act. It would require anyone with employees, 5 or more employees, to begin auto enroll at 6% and then ratchet it up to 10%. And it also has some increased tax incentives for small plans that want to establish a new plan.
And I think it's, it's virtually impossible for any of the Secure 2.0 stuff to pass this year between the infrastructure bill, the Building Back Better, and obviously raising the debt ceiling. There's just no possible, despite the fact that there's bipartisan support for most of those retirement bills, there's no way of getting them reconciled in the period of time we have left. There's some chance next year, maybe like Secure 1.0, when in December of 2022, they slip it in as a Christmas gift to plan sponsors. But it's going to be a tough lift, even in 2022, given the fact that the House is going to be out campaigning for re-election at that point.
No, that's a great point. Before we move on to the IRS, there were a couple other provisions in Secure Act 2.0 that were proposed that I think are just worth mentioning. Just a few small things. That it would add a new catch-up contribution for ages 62 to 64, so people getting closer to retirement could put up to $10,000 away. It allows for small financial incentives to get your employees to participate, so you can bust out those tchotchkes and start giving them away. It would allow 403B plans to begin using collective investment trusts, which are we do see on the 401k side. I think this makes sense to just get more equality across the different types of plans. And then it also expands the self-correction procedures, which we'll talk about. Haley will talk about more in a minute, and increases it. It requires increased awareness of the savers credit, so that lower income individuals understand the benefit that they can get by participating in their plan. Eric, Haley, anything to add on the legislation? All right, well, we'll move into the IRS next. The first item here is the IRS extended temporary relief from the physical presence requirement. And this is very much something that came out of coronavirus for sure. The physical presence requirement required that certain participant elections had to be witnessed by either a plan representative or a notary in person. Obviously, there wasn't a whole lot of in-person activity going on over the last 18 months or so. And so what this did was it said the standard is met if the document is executed via either live audio or video technology. This was recently extended to June 30th, 2022. Eric, what do you think? Is this just gonna be around for, is this just gonna end up being the new way we do business now?
Yeah, I mean, which I would hope, right, is that the notion of having to look around for who has a notary and having them come out and get their book out, and that somehow that is materially different, better, more secure than any other mechanism that we could use. I think, like other enhanced technology we've picked up over the course of the last 15, 18, 21 months, I think there is a high likelihood that the IRS eventually changes this. I mean, the challenge, of course, being that the same has been true for electronic disclosure, and that probably took a decade longer than most reasonable people thought it would. So the IRS is not quick to move on such issues, but this one they've already had to at least test out. So the hope is that we can get there much more quickly than we were in previous iterations.
Yeah, and I think I saw the American Retirement Association already is pushing for making this permanent. So, the pandemic did require us to look at a lot of things that we do, and now as we are hopefully coming out of it, we can start looking back and decide which one of those things made a lot of sense.
I should try to figure out if there's like a notary lobby who could be campaigning against this particular issue. There may be, right? Maybe there's a huge notary lobby that I'm not aware of.
All right. So next, the IRS had some changes to their correction programs. I know that Haley, throughout the course of the year, had drafted a couple blog articles on that. So rather than me wading through it, I think I'll turn it over to Haley to talk about some of those changes.
Sure, yeah. So the IRS did announce some changes to EPCRS. They love an acronym. So that's the Employee Plan Compliance Resolution System, which is basically where employers can go if they've discovered an error in the plan that needs correction. And the changes are a bit of a mixed bag. So on what maybe is the positive side, they increased the de minimis threshold where you wouldn't need to make a correction from $100 to $250. So a relatively large increase there. They also extended the self-correction program period for significant failures from 2 years to 3 years. So if you find it within that time, you can use self-correction rather than the more serious voluntary correction program. They also eliminated the requirement that if you're using an amendment to fix an operational failure and increasing a benefit for that fix, that it has to apply to all participants. So it no longer does. But in exchange for that help with the plan, they also removed the option for filing an anonymous voluntary correction program, where if you had a particularly thorny issue and you didn't really want the IRS to know that it was you, you could still go to them and get a blessing on a resolution. So that is no longer allowed. Instead, there is now a no-fee voluntary correction program pre-submission conference. So you go and talk to someone at the IRS about the issue ahead of filing, but they're not bound by any discussions or decisions that are made in that pre-conference. So it is a bit of a takeaway there. At the end of the day, I think my advice to plan sponsors will always be, if you find an error, loop in your consultant. If you've got a ERISA counsel, let them know, because you do not want to go talking to the IRS without all of your ducks in a row. So when there's an error, raise hand and get some help.
All right, good advice. The other item that came out, I think in August, was the IRS issued some of their priority guidance items. There are actually 19 items that they were going to focus on. Just a few of those that were probably the more substantive. Some of them were relatively minor, but they're looking to have an additional guidance on e-delivery rules. There's still guidance that's needed on several of the Secure Act items that we were talking about earlier. They do want to continue looking at student loan payments on their own. So, again, I think there's a lot of interest in the student loan issues and how to resolve those. And then also they indicated some interest in focusing in on the 10% early withdrawal penalty. I'm not sure what they're planning on looking at there. That 10% early withdrawal penalty has been there quite some time, but that is one of their areas of focus. The last item that we still need from the IRS really is the 2022 contribution limits. And I put a question mark there because they haven't been released yet, but we expect them to be fairly soon. And I thought Eric could comment sort of what are you anticipating? If you could, I don't want you to predict 100%, but give me a guess of what they're going to look like when they're released.
Yeah, I think for the first time in a long time, there's been some CPI numbers or inflationary numbers that are pretty substantial and could push those limits quite a bit higher for next year, separate and aside from the limit changes that Greg, you were talking about relative to Secure 2.0 and additional catch-ups and what have you. I think you'll see income limits go up. I think you'll see highly compensated limits go up, deferral limits go up, probably even catch-up contribution limits increase during this period of time. So good time to reprogram your payroll systems, very likely. Take a look at some of the testing data that comes out. But given the amount of inflation that we've picked up in 2021, and at least from the Fed's perspective, anticipated inflation in 2022, some of those limits are going to have to increase. It's always the challenge, though, back to the revenue issue that we were talking about. When those limits go up, then that is essentially deferred tax revenue. And I think you're going to see people take advantage of it, especially with the potential, especially through Build Better Act, of some increases in marginal tax rates for some Americans, the SALT, state and local tax issues that are still present.
All right. So next we'll move on to the Department of Labor, and the Department of Labor has been issuing some guidance on a few things. The first one, I mentioned earlier, the increased focus on lost and missing participants. And so the DOL did give out some best practices for keeping track of participants and locating those who are lost or unresponsive. I didn't feel like there was anything earth-shattering that maybe if you sat down and made a list, you'd probably come up with, probably 70% of their recommendations on your own. But at the same time, it's good to have some guidance and some understanding of what practices you should have. I think one component of it that's certainly important is, to the extent that you are taking action or your record keeper is taking action relative to lost and missing participants, is that you document what you're doing relative to that if you are doing something. So I think that's one of the takeaways that I got from that. The other guidance that we saw was some cybersecurity guidance from the DOL. There's a lot of data and information that is passed between an employer and their record keeper that is very sensitive. And I think there's increasing awareness of maybe some of the risks that poses. So some of the guidance there was some tips that really covered three areas of cybersecurity exposure. Tips for hiring a service provider, ensuring that they have the cybersecurity protocol that is necessary. Overall cybersecurity program best practices. And then the third component was some online security tips for participants. So Haley, so we've got this guidance on lost and missing participants. We've got the guidance on cybersecurity. So what's a plan sponsor to do now that that's sitting out there? They're certainly not required to do anything, right?
They are not required to do anything. It is just guidance. It is best practices, the Department of Labor's favorite thing. So I think my advice would be, make sure you read the guidance. It's worth sitting down and looking at your process for lost and missing participants and seeing how it aligns with the Department of Labor guidance. Similarly, I think it's worth looking at the cybersecurity guidance, and this is a really big piece of monitoring your record keeper. The DOL can't really get to these record keepers on cybersecurity, so the way they're going to do it is by auditing plan sponsors, monitoring of the cybersecurity of those vendors, and sort of it's a two-step process for them. So certainly we know that cybersecurity has been a Department of Labor audit focus in the last few months. I think it's going to continue to be an auditor focus. I think that you should read that guidance, make sure you are asking your record keeper how they're responding to it. And a lot of record keepers we've seen come out with handy guides that say, hey, this is what the Department of Labor asked you to ask us. This is our response. We think we're doing great. So at a minimum, read it, review it, document that you've gone through that process. Documentation continues to be the single most important thing you can do with anything really that comes out of the Department of Labor.
Yep. If you didn't document it, didn't happen, right?
Exactly. Yep.
All right, the next item is ESG and proxy voting rules. And as I think about it, if I was going to put a graphic on here, I probably would have put a roller coaster because the environmental, social, and governance investing rules, the last week before the election, the DOL put in some ESG rules that likely would have negatively impacted the use of ESG investments within retirement plans, I think, over time. The Biden administration pretty quickly said, we're not going to enforce it. And then a little bit later said, not only are we not enforcing it, we want it reviewed. And really, if you watch what's happening, especially as it relates to ESG, I feel like since the election, there's more and more talk about promoting ESG investing within retirement plans as something that retirement plans should do, whereas the original DOL rule would have really minimized it. And, on this topic, I'm just going to open it up to you, Eric, to just sort of pontificate on where you see ESG going, because it seems like it's become political and it's just being pulled both ways, but it's being pulled pretty quickly, it feels like.
Yeah, I think the challenge is while there is broad consensus, I think Secure 1.0 passed with only 5 members of the House voted against it. So these are, essentially bills where there are tremendous agreement between the two parties about retirement plans in general. This is maybe the sole area where that isn't the case. And the political lines here are pretty significant. And they're always tied together, ESG and proxy voting. I think the world would benefit potentially from separating them to some degree. I think, frankly, the ESG rules are not particularly controversial. I think we had, prior to the most recent rule from the Department of Labor, arrived at a point where, hey, you've got fiduciary risk anytime you select an investment product. ESG products are no different. You need to understand those products, how they operate, and you can continue down that path. Trying to create some kind of special burden or obligation relative ESG seemed to be a step pretty significant against ESG, and one that wasn't likely to stand and doesn't look like it will. The proxy voting issues are going to be much more sticky. I think the challenge with proxy voting comes down to where political parties derive a lot of their contributions. And candidly, the Democrats tend to do well with organized labor as far as political contributions go. Republicans in general tend to go toward business to get their contributions. And there is a real concern that potentially proxy voting could be a battleground where largely pension plans, this isn't even primarily defined contribution issue, we're largely talking now about pension plans, might exercise voting in such a way that would be detrimental to the interest of one party or the other, which is why this pendulum swinging back and forth on proxy voting. It is true that the Department of Labor proposed a new rule, which essentially would trump the prior Trump rule under the prior Department of Labor. That has made it through the General Accounting Office, I think yesterday or the day before. My only hot take of the day is I think we may have a rule as early as tomorrow. The Department of Labor loves dropping rules on Friday afternoon, and it's through the GAO. This is a priority. So it would not surprise me if you check your retirement plan feeds, which I know all of you are on, that you'll have a new rule to read about over the weekend. But I would expect to see something that is far more accommodating of ESG specifically. And I do hope that we get to something rational on the proxy voting side. For defined contribution plans, the whole proxy voting issue is not one of high significance anyway, but I continue to feel like it's confusing plan sponsors who are not sure which proxies are supposed to be voted, when they're supposed to be voted, and how they're supposed to be voted. And I think that creates a lot of confusion, which is unneeded in the current environment.
All right, thank you. This last item is actually not something the DOL is doing. It's actually something that they're being told potentially to do. The GAO reviewed fee disclosures, was asked to review fee disclosures, and conducted a lot of interviews with participants and individuals. When fee disclosures rolled out, my comment back then was that I thought it was maybe the U.S. Postal Service was behind requiring fee disclosures because there was a ton of paper being mailed all over the place. But I think as far as the value of that information is really what the GAO is looking at. And what they really came up with was that participants receive very little value from the complex nature of the fee disclosures that are currently going out. And part of their surveys found that 40% of the respondents don't understand the fees that they're being charged. 45% are incapable of determining what amount they are paying. And a full 41% didn't think they were paying fees. So the GAO came up with 5 recommendations that they sent to the Department of Labor. They're in our regulatory update. Just to note, the DOL has not given any sort of response. They haven't said we're going to look. I mean, they don't have to do anything with them, to be honest. So if they choose to ignore them, they can ignore them. But I think there are some ideas. The biggest one is not a requirement, but encouraging the use of common terms for identical things, which I think that alone would maybe go a long ways to helping. So that's really the last item we had on the Department of Labor. Moving into the last section here is the litigation. And there continues to be a lot of ERISA litigation, both in college and university 403B plans and on the 401k side. But before we talk about some of these specific plans, I would say that almost all the plaintiffs' allegations are typically similar, if not the same. I mean, in fact, if you saw some of these that are filed by the same law firms, they're the exact same number of pages. They're exactly 43 pages. And and pretty much everything's the same except for maybe the name of the defendant. And so some of the things that we continue to see as allegations, these are just allegations, doesn't mean they're proven, is failure to negotiate lower record keeping fees, offering too many investment options, failing to monitor investments, offering multiple record keepers, and charging fees based on assets instead of the number of participants. Those are what we typically are seeing in most ERISA fiduciary cases. As far as some of the activity we've seen recently, you might remember the New York University case. This actually went to a bench trial and was found fully in favor of New York University. Plaintiffs appealed the dismissal of 6 of their claims, and the appellate court sent 2 of those claims back to the lower court for further review. One of them related to offering the lowest share class, and what the higher court or the appellate court said was the lower court looked at the 80 to 110 investment options and sort of said, well, as a group, yeah, there's a few in here that could have a lower share class, but for the most part, people can find what they need to get a low cost investment. And the appellate court said, no, you actually can look at individual investments and determine if the fiduciaries met their duty in including those in the plan. So we'll see how that turns out. The other one was prior to the trial, the plaintiffs attempted to amend their claim to add defendants. They wanted to add 17 individuals. And in the case, the only defendant was the New York University committee. That was the only named defendant. And so prior to the bench trial, the plaintiffs tried to say, well, wait a minute, we want everyone who's been on that committee, we want them named in here as well. And that was denied. The appellate court determined that the wrong legal standard was used to deny adding those individuals, and also said the claim needed to be re-adjudicated at the lower level because the bench trial found that certain committee members didn't really understand their fiduciary responsibility as it relates to the plan. And this will be an interesting thing to watch. If they are brought back into the case in their individual capacity, whether or not you can find that the committee as a whole did what it was supposed to do, but you had certain individuals that breached their fiduciary responsibility as an individual to that plan. So we'll be keeping an eye on that one for sure. Columbia University settled their case as a $13 million settlement. Pretty standard non-monetary provisions that we see here. Mandatory fiduciary training for their committee, pricing record-keeping fees at the per participant level rather than asset-based, review and offer of the lowest share class, continued use of an independent investment consultant. They will conduct an RFP for the record-keeping service. The last 2 are ones that I don't know that we saw a lot at the beginning, but we're certainly seeing in most of the settlements now. Preventing the use of plan data for non-plan products and services. Now we're seeing this one quite a bit. And then the final one, I don't know if I'd seen that much until this Columbia one, is a requirement that they inform participants to the extent that you have frozen legacy assets and participants that are invested in those assets. There's a requirement that they inform participants of their ability to redirect those assets out of those frozen, often non-monitored investment options. We also have one going to the Supreme Court. The Northwestern University case was dismissed in its entirety without a trial. And what's happening, if you think about it, New York University made it to trial, very similar allegations. And so I think what we're looking for here from the Supreme Court is, the success or failure of your lawsuit right now very much depends on where you filed the lawsuit. And I think that's what we're looking to get some clarity on is, the answer that I think the Supreme Court needs to come up with is what is sufficient for a plaintiff to state a viable claim for a breach of a fiduciary duty under ERISA as it relates to selecting and monitoring investments. And I think everyone will be watching this decision because it could significantly change the way plaintiffs elect to plead their initial cases, if that, depending on which way it goes. This will be brought before the Supreme Court this session. We would expect a decision sometime in 2022. Moving on to the 401k litigation, there's a case to update you on with Turner versus Schneider Electric. This is a breach of fiduciary duty and loyalty claims against both the employer and the investment consultant. And the issue here was the investment consultant had introduced some new collective investment trusts that were used as the target date options, replacing the current mutual fund options. The court determined that the case can move forward, not because the CITs were poor performing and not because the performance relative to other options was inferior. It actually said it can move forward because the CITs had a very short track record. And it was decided that it is worth moving the case forward to understand whether there was a breach of fiduciary duty if there's not a long enough track record to determine whether or not this is an appropriate investment for a plan this size. Interestingly enough, the breach of the duty of loyalty was dismissed against the employer, but was dismissed as it relates to Schneider Electric, but proceeded against the investment advisor. And the loyalty issue there was whether or not the investment advisor was making additional revenue by pushing their proprietary collective investment trusts. And this sort of brings us pretty close to the end of today's webinar, but I wanted to close with a question to Eric. What do you think a decision like this means, both for plan sponsors and for investment consultants, when we start to see not just the plan sponsor, but the investment consultant being pulled into the litigation directly?
Yeah, I mean, I think it's good that frankly, the investment consultants are being pulled into the litigation. I think for plan sponsors, there's a risk here as well, right? Which is that once upon a time, you had your record keeper who moved data from here to here, processed payrolls, distributions, enforced the plan rules. You had your investment managers who obviously had the dollars and selected the stocks and bonds, delivered the returns to participants. And then you had an investment consultant who is helping with the monitoring, selection, and review of investment products. And what we've seen, regrettably, over the last several years is a real blurring of those lines. And they're free to blur those lines because, back to Haley's point, the Department of Labor has no way of enforcing any of these fiduciary breaches on the vendor side. Their exclusive capacity is on the plan sponsor side. So through litigation, you're seeing record keepers who are being essentially targeted through litigation because of their practice of selling non-retirement plan products to participants. So blurring that line of record keeping to some kind of product sale. And you are clearly seeing investment consulting shops who no longer want to get a fixed fee for doing just investment review work and plan consulting, and instead fancy themselves investment managers. I mean, it is tempting, right? I have a CFA. It'd be tempting to be a portfolio manager overseeing $1 billion fund. It's a far more lucrative profession, but ultimately it makes the consultant unable to do their duty on the monitoring side. And I think that that's a real problem. We see it with these custom managed accounts. We see it with custom target date funds. We see it with these transition to 338 arrangements that are proprietary products, as was the case in the Schneider Electric case. So I think there has to be some accountability there. I think, but the same is true of then plan sponsors, which is they need to better understand what the roles of the parties are. If you look at the amount of merger and acquisition activity in the retirement plan consulting space, I would argue it has very little to do with economies of scale. It has everything to do with leveraging those trusted relationships that consultants have with clients to sell other products and services. And I don't ultimately think that that's in the best interest of plan sponsors from a fiduciary perspective and plan participants from an outcomes perspective. But that's where the market seems to be moving, and hopefully some of this litigation may slow that down.
Yeah, thank you. All right, that brings us to the end of today's webinar. I didn't have access to any questions, so I wasn't sure if there are any questions that came in, but if you guys can let me know if there are. I would encourage everyone, and we will be sending out a link to our full 2021 regulatory update following this webinar. So if you haven't read that, sit down and enjoy your reading. Any questions, Eric, that came through, or Haley?
Not yet. Maybe we'll give it 1 minute to see. I always worry that somebody's, furiously typing out a question in the question box or chat box. To Greg's point, the data here will be provided, both the recording link as well as the actual materials. So if you miss something or you need to share it with a colleague or coworker, please feel free to do so.
And if you think of a question in 3 hours, which is what always happens to me, you can of course reach out to your consultant or to any of us. Yeah.
Great. Thanks, everybody. Hope
Thank
you have
you.
a wonderful day.
Thank you. Bye-bye.